Welcome to CMA USA Exam Coach. In today's session, we're going to dive into one of the most essential tools for financial analysis, profitability ratios. These ratios help us understand how well a company is generating profits relative to its revenue, assets, or equity. Whether you're an investor, financial analyst, or CMA candidate, mastering these ratios is crucial for evaluating a company's financial performance. So, let's get started with a clear and simple breakdown of profitability ratios. What is profitability ratio? Profitability ratios measure a company's ability to generate profit relative to its revenue, assets, or equity. These ratios are essential tools in financial analysis. They help us assess a company's financial performance and operational efficiency over a specific period. In short, profitability ratios show how effectively a business turns its resources into net income, making them vital for both management decisions and investor evaluations. Profitability ratios in the CMA syllabus. In the CMA USA syllabus, profitability ratios are divided into two main categories: profit margin ratios and rate of return ratios. In this episode, we'll be discussing all the key ratios under both categories. Under profit margin ratios, we'll cover the gross profit margin, operating profit margin, net profit margin, and the EBITDA margin, all of which measure different layers of profitability from sales to operational efficiency. Then, under rate of return ratios, we'll focus on return on assets, return on equity, and return on common equity, which evaluate how effectively a company generates profit from its assets and shareholders' investments. Let's break down each of these ratios with clear examples and explanations so you're fully prepared for your CMA exam. Now, let's look at the gross profit margin ratio, an important indicator of a company's core profitability. This ratio shows the portion of revenue that remains after subtracting the cost of goods sold. It helps us understand how efficiently a company produces its goods and how much profit it retains before covering other expenses. Formula: gross profit margin ratio equals to gross profit divided by sales times 100. As you know, gross profit is the difference between sales and cost of goods sold. In simple terms, this ratio tells us how much gross profit is earned from every dollar of sales. We'll see a practical example in the upcoming slides to bring this formula to life. Operating profit margin ratio. Moving on to the operating profit margin ratio, this ratio gives us valuable insight into the company's earnings from its core business operations. It measures how much profit is left after deducting the cost of goods sold and all operating expenses such as salaries, rent, utilities, and admin costs. Unlike the gross profit margin, this ratio reflects the company's operational efficiency before considering interest and taxes. Formula: operating profit margin ratio is equal to operating profit divided by sales times 100. Operating profit, also known as EBIT, earnings before interest and taxes, focuses on income from the core business, excluding non-operating items. This ratio is useful to understand how much profit the business generates from its day-to-day operations per dollar of sales. Now, let's talk about the net profit margin ratio, the bottom line of a company's profitability. This ratio tells us how much of the total revenue remains as net income after deducting all expenses, including operating costs, interest, and taxes. It's a complete picture of profitability, showing the actual earnings available to shareholders. Formula: net profit margin ratio equals to net profit divided by sales times 100. Since this ratio includes all costs and expenses, it's often used to assess the company's overall financial health and sustainability. In simple terms, it shows how much true profit the company makes for every dollar of sales. Let's discuss EBITDA ratio. Before that, let's first understand what EBITDA actually means. We all know about EBIT, earnings before interest and taxes, and EBT, earnings before tax. But now let's check out EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization. It's a measure of a company's operating performance, showing how much profit it generates from its core operations before any non-operating expenses or non-cash items are considered. By removing depreciation and amortization, EBITDA gives us a better idea of pure cash profitability, especially useful in comparing companies across industries with different asset bases or accounting policies. Now that we've understood EBITDA, let's move on to the EBITDA. Margin ratio, and see how it fits into profitability analysis. EBITDA. Ratio focuses on the company's core profitability by removing non-cash expenses like depreciation and amortization, as well as interest and tax effects. It's especially useful for comparing companies across different industries or capital structures. Formula: EBIT a margin ratio is equal to EBITDA. Divided by sales times 100, EBIT a margin gives a clearer picture of the operating cash flow potential of the business, since it focuses on profitability from pure operations before the impact of financing and accounting decisions. This ratio is often used by investors and analysts to assess the core earning power of a company, especially in capital-intensive industries. Now that we've learned the key profitability ratios, let's put them into action using a practical example. In this slide, we'll walk through a sample income statement and calculate each ratio based on the values we've discussed earlier. This will help us understand how these ratios are applied in real business analysis and what each percentage truly means. Let's begin with the data provided. The revenue is $500,000. The cost of goods sold is $200,000. When we subtract cost from revenue, we get a gross profit of $300,000. Next, we have operating expenses or fixed costs amounting to $100,000. Subtracting this from the gross profit gives us an operating profit, also known as EBIT, of $200,000. From this, we deduct interest of $20,000 and tax of $54,000, which leaves us with a net profit of $126,000. Let's start with the gross profit margin. The formula is gross profit divided by sales multiplied by 100. In this case, we have a gross profit of $300,000 and sales of $500,000. Applying the formula, 300,000 divided by 500,000 gives us 0.6 or 60%. This means the company retains 60% of its sales revenue after covering the direct cost of producing goods. It indicates strong control over production costs or good pricing power. Next is the operating profit margin. The formula is operating profit, or EBIT, divided by sales multiplied by 100. Here, EBIT is $200,000 and sales are $500,000. Dividing $200,000 by $500,000 gives us 40%. This tells us that 40% of the revenue remains after covering both direct and operational expenses. It reflects the company's operational efficiency and the profitability from its core business activities. Now let's look at the net profit margin. The formula is net profit divided by sales multiplied by 100. The net profit is $126,000 and the sales are $500,000. 126 divided by 500 gives us 25.2%. This means the company keeps about 25 cents as profit for every dollar earned in sales, after paying all expenses including interest and taxes. This is a key indicator of overall profitability and financial health. These three margins, gross, operating, and net, give us a complete understanding of how profit flows through a company's operations, from production to final earnings. In the next slide, we'll explore EBITDA and how it gives even more insight into operational performance. For the EBITDA margin ratio, let's look at a new example. In this case, the company has total sales of $800,000 and an EBITDA of $350,000. To calculate the EBITDA margin, we use the formula EBITDA divided by sales multiplied by 100. So we divide 350,000 by 800,000, which gives 0.4375 or 43.75%. This means that 43.75% of the revenue remains after accounting for operating expenses, excluding depreciation, amortization, interest, and taxes. It reflects the company's operating profitability before non-cash and financing-related expenses. A higher EBITDA margin like this suggests strong operational performance and efficient cost control, which is a positive sign for both management and investors. That's all for the profitability ratios. We've covered how to evaluate a company's ability to generate profit from its sales, operations, and overall performance using margins like gross profit, operating profit, net profit, and EBITDA. Now, let's move forward and discuss the rate of return ratios. These ratios are designed to measure how effectively a company is using its resources, such as assets and equity, to generate returns. They are especially useful for investors and stakeholders who want to assess whether the company is delivering a strong return on the capital invested. Let's begin the next section, rate of return ratios. These ratios help us evaluate how efficiently a company is generating returns from the resources available to it. In other words, they measure how well the company is using its assets, equity, and shareholder capital to earn profits. Under this category, we'll go through three important ratios. First, return on assets, or ROA, which shows how much profit the company earns from its total assets. Second, return on equity, or ROE, which tells us how much return the company is generating for its common shareholders. And finally, return on common equity, or ROCE, which is a more refined version of ROE. That focuses specifically on the return available to common equity holders after accounting for preferred dividends. Let's start with ROA and see how it works in detail. Let's begin with return on assets, or ROA. ROA is a key profitability ratio that measures how efficiently a company uses its assets to generate net income. In simple terms, it tells us how much profit a company earns for every dollar invested in its assets. This ratio is important because it reflects how well management is utilizing the company's resources to drive earnings. It helps both internal decision-makers and external investors evaluate operational efficiency. A higher ROA indicates that the company is making good use of its assets to produce profits, which is a sign of strong financial performance. On the other hand, a lower ROA may suggest inefficiency in asset utilization, or that the company is overinvested in assets that are not generating enough income. The formula to calculate ROA is net income divided by average total assets multiplied by 100 to express it as a percentage. To understand ROA, we've created a short video. Watch the video to understand more about ROA.
Return on assets, or ROA, is a crucial financial ratio. It tells you how efficiently a company uses its assets to generate profits. In simpler terms, ROA measures how well a company turns its stuff into money. A higher ROA indicates better profitability and asset utilization. Think of it like this: you have a lemonade stand. Your assets are the lemon's sugar and stand itself. Your profit is the money you make from selling lemonade. ROA tells you how much profit you're making for every dollar invested in your lemonade stand. ROA is expressed as a percentage. This makes it easy to compare the profitability of companies, regardless of their size or industry. ROA is a vital tool for investors. It helps them assess a company's financial health and management effectiveness. By comparing the ROA of different companies, investors can identify those that are most efficient at generating. A high ROA suggests that a company is using its assets effectively. This could indicate strong management, a competitive advantage, or both. On the other hand, a low ROA might signal inefficiency, changing market environment. Investors use ROA to make informed decisions about buying, holding, or selling stocks. A company with a consistently high ROA is generally considered a good investment. This is generate strong returns for shareholders. Calculating ROA is relatively straightforward. The formula is as follows: ROA equals net income divided by average total assets. Net income is the company's profit after all expenses have been deducted from revenue. Average total assets represent the average value of the company's assets over a specific period. This is typically calculated by averaging the assets from the beginning and end of the period. Let's say Company A has a net income of $100 million and average total assets of $500 million. Its ROA would be ROA equals $100 million divided by $500 million, which equals 0.2 or 20%. This means that Company A generates a 20% profit for every dollar invested in its assets. Let's look at two hypothetical companies to illustrate how ROA can be used to evaluate performance. Company X manufactures high-end smartphones. It has an ROA of 15%, indicating strong profitability and efficient asset utilization in a competitive market. Company Y operates a chain of budget-friendly retail stores. Its ROA is 5%. This suggests that while Company Y generates revenue, it might not be using its assets as effectively as Company X. By comparing their ROAs, investors can see that Company X is generating higher profits from its assets than Company Y. This information can help investors make more informed decisions about where to allocate their capital. Remember, ROA is just one of many financial ratios investors use. However, it's a powerful tool for understanding a company's profitability and efficiency. By keeping an eye on ROA, you can make smarter investment choices and potentially boost your returns.
Next, let's explore return on equity, or ROE. ROE is a fundamental ratio that measures how effectively a company is generating profit using the money invested by its shareholders. In simple terms, it shows how much return the company is providing for every dollar of equity. This ratio is especially important for investors as it reflects the company's ability to create value from shareholders' capital. It's often used to compare profitability across companies in the same industry. A high ROE means the company is efficiently using its equity to generate profits, which is usually a positive sign and indicates strong financial performance and good management. A low ROE, on the other hand, may signal that the company is not utilizing its equity effectively, or that profits are being diluted by high debt or poor operations. The formula to calculate ROE is net income divided by average total equity, multiplied by 100. To understand this better, we've created a short video. Let's watch.
Imagine a tool that reveals how well a company turns your investment into profit. That's return on equity, ROE. It's a key metric that shows how efficiently a business uses shareholders' investments to generate profits. A higher ROE indicates that a company is making the most of its equity to generate profits. It's like getting more bang for your buck, showcasing efficient use of resources for maximum profitability. The ROE formula is simple: net income divided by shareholders' equity multiplied by 100. This percentage reflects how much profit a company generates with each dollar of equity. Net income is the profit after all expenses, while shareholders' equity is the total assets minus liabilities. Together, they form the backbone of the ROE calculation, offering insights into profitability. Investors use ROE to gauge a company's profitability and potential. A stable high ROE suggests sustained profitability, making it a preferred choice for long-term investors seeking reliable returns. Companies with fluctuating or low ROE may raise red flags for investors. It could indicate business instability, prompting investors to reconsider their investment decisions. A consistent or growing ROE signals strong management and financial health. It reflects a company's ability to maintain profitability and efficiently manage resources over time. Conversely, a declining ROE might indicate inefficiencies or excessive debt usage. It's a red flag for investors, suggesting potential issues with management or financial strategies. ROE is a powerful tool for comparing companies within the same industry. A higher ROE suggests better return potential for shareholders, making it a key metric for investment decisions. Investors look for companies with superior ROE as it indicates efficient use of equity. It's a benchmark for assessing profitability and potential returns across similar businesses. Financial leverage or debt can significantly influence ROE. While it can boost returns, excessive debt increases financial obligations, posing risks to the company's stability. DuPont analysis breaks down ROE into components, highlighting the impact of debt. A high ROE driven by debt might be risky, signaling potential financial strain. ROE varies across industries. Tech companies often have higher ROE due to lower capital needs, while manufacturing firms might have moderate ROE due to high fixed costs. A negative or very low ROE could indicate financial distress or poor management. It's crucial to compare ROE within the same industry for accurate insights. Let's calculate ROE for Company A with a net income of $500,000 and shareholders' equity of $2 million. The ROE is 25%. This means for every dollar of equity, the company earns 25 cents. A 25% ROE indicates strong financial performance and good shareholder returns. It suggests the company efficiently uses its equity to generate profits, making it an attractive investment. In summary, ROE is a vital metric for assessing profitability and management efficiency. By understanding ROE, investors can make informed decisions and identify companies with strong financial health. By focusing on companies with high and stable ROE, you'll enhance your investment portfolio. It's a key indicator of financial success and a tool for identifying potential growth opportunities. Now that you understand ROE, apply this knowledge to evaluate your investments. Look for companies with strong ROE to maximize your returns and ensure financial stability.
Now let's talk about return on common equity, or ROCE. ROCE is a variation of ROE. That specifically focuses on the return available to common shareholders after preferred dividends have been paid. It gives a more accurate picture of profitability from the perspective of ordinary investors. This ratio is important because common shareholders are the actual owners of the company, and ROCE tells them how effectively their capital is being used to generate net income. A high ROCE means the company is delivering strong returns to common shareholders, which can lead to higher investor confidence and potentially stronger stock performance. A low ROCE may suggest that the company is not generating sufficient returns from the equity of its regular shareholders, possibly due to high costs, lower profitability, or excessive use of preferred capital. The formula is net income minus preferred dividends divided by average common shareholders' equity multiplied by 100. For ROCE, we're specifically focusing on net income that is available to common shareholders, which means we subtract any preferred dividends that need to be paid first. We then compare this income to the common shareholders' equity, giving us a clear picture of how well the company is using the equity invested by regular shareholders to generate profits. In simple terms, ROCE highlights how effectively common equity is being used to produce returns for the actual owners of the company. Now, let's discuss the ratios using the scenario we have. Here we are given the comparative balance sheet for year 1 and year 2, along with the revenue, net income, and preferred shareholder dividends of $30,000 for year 2. We will focus on how to calculate the key financial ratios using the provided data. We'll be calculating these ratios step by step, starting with ROA and ROE, finally ROCE. The first step in our ratio analysis is to calculate the average for total assets and shareholders' equity. As we know, to calculate an average, we simply add the opening balance and the ending balance, then divide the result by 2. Let's start with total assets. The opening balance is $850,000, and the ending balance is $1 million. Adding them together gives us $1,850,000. Dividing by 2, we get an average total asset value of $925,000. Next, we calculate the average shareholders' equity. The opening balance is $500,000, and the ending balance is $560,000. Adding these gives $1,060,000, and dividing by 2 gives an average equity of $530,000. So, this completes the first step in our calculation. We now have the average total assets and average equity, which we'll use in the next steps to compute various financial ratios. Now, let's calculate return on assets, or ROA. ROA tells us how efficiently the company is using its assets to generate profit. The formula is simple. Return on assets is equal to net income divided by average total assets. In our case, the net income is $180,000, and the average total assets, which we calculated earlier, is $925,000. Dividing $180,000 by $925,000 gives us 0.1946, or when we convert that into a percentage, we get 19.46%. This means the company is generating a return of 19.46% on its total assets. In other words, for every dollar invested in assets, the company is earning about 19.5 cents in profit. That's a strong indication of efficient asset utilization. Next, let's calculate return on equity, or ROE. ROE measures how effectively the company is using its shareholders' equity to generate profit. The formula is net income divided by average shareholders' equity. In this case, the net income is $180,000 and the average equity, which we calculated earlier, is $530,000. Dividing 180,000 by 530,000 gives us 0.3396, which is equal to 33.96% when expressed as a percentage. This means the company is generating a return of 33.96% on the equity provided by shareholders. In simple terms, for every dollar of shareholders' equity, the company is earning about 34 cents in profit. That's a very strong return and indicates effective use of shareholders' investment. Now let's calculate return on common equity, or ROCE. ROCE focuses specifically on the return available to common shareholders after paying out any preferred dividends. The formula is net income minus preferred dividends divided by average common shareholders' equity. In our case, the net income is $180,000 and the preferred dividends are $30,000. Subtracting the dividends from net income gives us $150,000. This is the income available to common shareholders. Next, we calculate the average common equity. The opening balance is $200,000 and the ending balance is $220,000. Adding them gives $420,000, and dividing by 2 gives us an average common equity of $210,000. Now we divide the income available to common shareholders, $150,000, by the average common equity, $210,000. This gives us 0.7143, or 71.43% when converted to a percentage. This means the company is generating a return of 71.43% on the capital invested by common shareholders. It shows a very strong profitability from the perspective of ordinary investors. Let's now interpret the results of our profitability ratios. Return on assets is 19.46%. This means the company is earning nearly 20 cents in profit for every dollar of assets it owns. It reflects efficient use of assets to generate income. Return on equity is 33.96%. This indicates the company is generating a strong return on shareholders' equity. For every dollar invested by shareholders, the company is returning about 34 cents in profit. That shows solid financial performance. Return on common equity is 71.43%. This is an exceptionally high return from the perspective of common shareholders. It means that after paying preferred dividends, the company is delivering a very strong return to ordinary investors. It reflects highly effective use of common shareholders' capital to generate profit. Overall, these ratios suggest the company is financially healthy, efficient in operations, and delivering excellent value to its shareholders. To summarize, profitability ratios help assess how effectively a company generates profit from its sales, assets, and equity. These ratios are crucial for evaluating a company's financial health and efficiency. The profitability ratios we discussed are gross margin ratio, which measures the percentage of revenue remaining after subtracting the cost of goods sold. Operating margin ratio, which shows the percentage of revenue left after covering operating expenses, excluding interest and taxes. Net profit margin ratio, which indicates the percentage of revenue that turns into profit after all expenses are deducted. EBITDA margin ratio, which reflects the percentage of revenue remaining after accounting for operating expenses, excluding depreciation, amortization, interest, and taxes. Return on assets, or ROA, which measures how efficiently assets are used to generate profit. Return on equity, or ROE, which shows how effectively shareholders' equity is used to generate profit. Return on common equity, or ROCE, which focuses on the return to common shareholders after paying preferred dividends. These ratios provide valuable insights into a company's profitability, operational efficiency, and how well it creates value for its investors. Thank you for watching! In the next episode, we will discuss activity ratios. I advise you to practice questions from the support package and focus on understanding the concepts. The more you practice, the faster you'll get, and this will help you manage your time better during the exam. If you found this video useful, don't forget to subscribe, like, and share the video. See you in the next episode.